I'm Scott Starratt with Starratt Wealth Management, a part of Canaccord Genuity Wealth Management. So this month has been really a continuation of the last few months as we've seen the markets continue to drift higher and really focused on the reopening of the worldwide economy. I think the biggest thing to note as far as in April goes is the incredible amount of money that has flowed from one area to the other. If you remember last month, I spoke about the difference between growth and value stocks. Growth being stocks that are expected to have very high growth rates, may not be super profitable at this point, but growing at a very high pace. So that would be companies traditionally in the technology sector. It may be drug companies, pharmaceutical companies. But other than that, it's the value stocks, which are most likely banks, energy, companies or sectors like that, that have really taken control of the overall market. And so what you've seen was the indices, the actual index itself has moved a little bit higher, but within the index, there's been a huge amount of volatility between these growth and value stocks. And so, for example, in the United States, one of the best ways to look at that is the difference between the NASDAQ and the Dow Jones. And on a lot of days in the month of April, as well as into May here, we're seeing days where the NASDAQ may be down a couple of hundred points, but the Dow Jones is up a couple hundred. So you've seen this big switch from, like I said, the growth stocks to the value stocks. And whether that continues or not is all going to be dependent upon what we see in the future. We definitely feel that the market is continuing to go higher, and the path of least resistance is for it to go higher. And the biggest reason behind that is the amount of cash that continues to be out there in the economy. Moody's did a study back towards the end of April that they came up with the fact that there's been globally about $5.4 trillion of excess savings in the system. So this is money that normally would have been spent, but in the last 12 months, it's grown to be about 5.4 trillion of excess money. So they took it the next step and said, well, what if a third of that money, so 33% of that money, is spent? That would mean that the gross domestic product of the globe would increase by about 2% in 2021 and another 2% in 2022. So essentially what that's saying is in the economy, if economies are growing at 3 to 4%, which has been the long-term growth rate of the US and Canadian economy over the last 10, 15 years, if they're growing at 3 to 4%, that would mean a 2% increase would be a very significant increase for the economy. And I think that's what's happening, are the stocks are reflecting that at this point. Now, that's all the positive, as well as, of course, more vaccines out, economies reopening, more people back to work. That's very positive. The biggest negative that we continue to see is that of interest rates, and the way that's best expressed is through inflation. As inflation increases, there's going to be more and more pressure on the central banks, such as the Federal Reserve in the US, the Bank of Canada in Canada, the European Central Bank, etc., to want to increase their interest rates, or at least stop printing as much money as they're printing now. And so that's probably the biggest risk that we know of, and of course, chances are it's going to be a risk we haven't even thought about that causes things to take a drop down. But that's the biggest risk we know of at that point, is that the economy becoming as superheated potentially as it could be, with all the stimulus money coming out of the US and in Canada and in Europe and in Japan, as well as all the potential for a downturn in an upturn in inflation due to things like, really straightforward things. The fact that, the Suez Canal, backlog has meant that parts on container ships, etc., have not reached their intended destination as fast as they should have. And what that would mean is that the cost of goods will go up because there's less goods out there. You look at cars as a perfect example. There's a lot of car manufacturers that are running short of the chips that are used in cars. So they have the car essentially complete, except that they're missing chips to go into the cars. And so that means that they can't sell the cars. So what do you think happens to the cars that are on the lots today? Well, you aren't probably getting a good deal on any of the new vehicles. And as a matter of fact, looking at some of the manufacturers, the dealerships, they're actually making record amounts of money off used vehicles. Because if you need to buy a car and there aren't any new ones on the lot, you're left with having to buy a used one. So I think that this volatility caused by inflation is only going to increase in the coming months. That will give us an opportunity to invest some of the cash that we do have in most portfolios. And it will also allow us to really be focused on making sure that we're in the right areas and the right investments. Because we think that over, like I said, the next few years, there's going to be a lot of volatility as it applies to inflation, interest rates, and what direction the economy goes. The other interesting thing that's out there, I would say right now that I wanted to share was the amount of money that people are now holding in stocks. You know, if you're sitting at home and you're thinking, okay, I have a chunk of money, where do I put it? Well, the bank accounts are paying you zero. Bonds have actually decreased in value over the last 12 months, meaning that if you were in a traditional bond fund at a bank or at an institution, you would see your bonds drop, in some cases significantly, over the last couple of months. And so what we've seen is in the United States is that about 41% of financial assets are now in stocks. That's a record high. So more, whether it be retail investors or more people in their self-directed RSPs, have money into stocks right now. Now, you compare that to the flip side, which is institutions and hedge funds. They have been selling stocks at a multi-year record amount. So the amount of stocks that are now, or amount of money, that's now flowing into the stock market from endowments, from pensions, from hedge funds, is at a multi-year low. So on one hand, you could say, well, they're just a little behind the times, and eventually they'll catch up and realize that they need to put more money into stocks in order to make money for their investors. Or the retail investor is wrong, and we're due for a correction that could last for a little bit, or it could be very short. We're of the belief that it's probably a pretty short correction. And we're also of the belief that because of how much money is behind the scenes and in savings and is to be spent as the economy reopens, that we're probably in for a very positive end of the year. But again, anything can change depending on the environment that's out there today. The last thing I want to point out as far as the portfolios go, as far as the market goes, is that we're really focused, continue to be really focused on keeping the money safe. We're really focused on ensuring that we have a cash balance ready to deploy in case the markets were to drop. And we're also very focused on ensuring that the managers that we do have on the equity side are doing their job. And happy to report that they're all doing great. All of our equity managers are doing as we expected. Some of them have had a little bit of a headwind with currency. For example, if they never hedged or protected against a rising Canadian dollar, they've been hurt a little bit because the Canadian dollar, as of I looked just right before shooting this, was at 1.2079. So quite a difference from the 1.33 that things were at about 6 months ago. So we've had a really big decrease in the US dollar and therefore an increase in the Canadian dollar pricing. Whether that continues or not, we don't know, and I don't think anyone knows. It'll depend upon things like commodity prices and other events. But I think that definitely the Canadian dollar is much stronger than it was 6 months or even a year ago. On the administrative side, Hengi and Angela spent a lot of time working with you and your accountants to make sure that tax season went as well as can be expected this year, especially considering between the two, a lot of people were between the two places of Richardson and Canaccord. So we appreciate your patience and always still available if there are any questions that do come from that. One of the things that Jim and I and the rest of the team are really going to focus on in June, July, and August is ensuring that we have proper information on our file when it applies to anybody's capital gains and losses, incomes, and tax-free savings accounts and RSP contribution amounts. And the importance behind that from our standpoint is when we get into the end of the year and we're making recommendations based on, whether things should be sold or bought at a loss or a gain in order to try to manage capital gains a little bit. We want to have a really good idea as to where your portfolio, where your tax situation is, so that we can give the proper advice. The income is important for some of our older clients because we want to avoid any old age security clawbacks. So that starts around $77,000. So if we can keep people under $77,000, that'd be great. That would mean they would receive their whole old age security check every month. And so we manage that a little bit as well to make sure that we're giving proper advice on that. So having that income amount is great. And finally, on the tax-free savings accounts, we just want to make sure that we haven't over-contributed. We want to make sure that we're on top of things there and that we're contributing the appropriate amount to the tax-free savings accounts. So we're going to add that to the agendas in the coming review periods. However, if you receive your notice of assessment from CRA in the last little bit, or you will in the next few weeks, please don't hesitate to send that to us or let us know. Any one of us would be more than happy to chat with you and get that information so that, like I said, we can make proper recommendations when it comes to the end of the year as it applies to tax and these other things I spoke of. So that's about it for now. I hope everyone still continues to be safe and healthy. And Jim and I are here to speak to yourselves, or obviously to anyone that that may be going through a tough financial time as it applies to their investments and maybe uncertain as to the direction ahead. More than happy to chat with them about that. In the meantime, please reach out to Hengi, Jim, myself, and Angela if you do have any administrative or investment questions. Thanks.